Hi there, James Gainmore Solutions, and welcome to this video. Now today I want to talk around how companies are able to acquire business loans and be able to borrow from banks. Now over the last few weeks I've been working with a small number of companies who are either early stage startup or still in their infancy of their business life cycle. And on each occasion they have all needed to be able to go and raise some level of investment to help them to set up, start up, improve their offering, invest in themselves and be able to take some financial support to allow them to take their business to where they want it to be. Now these are all early stage, however it's been really indicative as to what's going on in the banking industry currently around business loans. Now, you would have seen that interest rates have gone up recently, and that has helped, I think, to allow more banks to look to lend. So I'm not saying lending has become easier or borrowing has become easier, but I do think that over the last month or so, there's been more allowance of banks to take applications from businesses, especially early stage businesses, and look more favourably on them. But the important thing is that when you are, as a business owner, going to a financial institute and asking for investment in the form of a loan, there's certain things you have to do. Now, some of these are basic and a lot of these you will know anyway. But over the last sort of 6-7 weeks, with the clients I've been working with, we've uncovered a number of areas that are really sort of hot right now. So the key things to look at is, depending on the size of your business and how much money you're looking at trying to borrow, banks are looking at household income. So how much money have you got around yourselves in order to help safeguard their investment? Now, clearly, things like CCJs and all of that are personal to you will score against you. So you may need to look at how you actually apply and apply in the right manner. But you must make sure that your household income is as optimized as possible. Now, this isn't about telling falsehoods and not telling the truth about what your income is and your expenditure is, but it's about understanding at what point of the year should you be looking at these loans where you're maximizing your household income. So that's the sort of household income. The second part is more around the business. So this is your business revenue. So what is your current revenue? Now, if you're a startup, that's going to be harder to do because your revenue will undoubtedly be smaller, but actually having an understanding and a good grasp of what your revenue is and what your profitability is. Now, banks are okay about the here and now, but they also want to see projection. So they'll want to see with some level of confidence how you're taking your revenue now to where it needs to be. And it might be that the only way you can do that is through this loan, and that's fine, but they will want to see some level of confirmation that your numbers are going in the right way. They will also want to see cash flow forecasts. So it's all well and good having great revenue, but if your cash flow isn't strong enough, that's what's going to kill your business. And the bank don't want to lend in a risky manner. A, they don't want to, and B, they're not allowed to take risks as part of the regulations that they work under. So they all need to see a cash flow forecast. Now, if you're that way inclined and you're on your numbers, then great, go ahead and do it. Alternatively, speak to an expert, maybe your accountant or your bookkeeper, or an expert that you know that's done this before, to understand what your cash flow forecast should look like, because that's a question that will be asked by the financial institute. And it's always better to provide all the information up front, because otherwise, if you miss something, A, they're going to come back and ask you, and you're going to have to retrofit that number or that report for them that you could have presented to begin with. Or it's going to be a bit of a red flag to them that says, actually, this business doesn't have a cash flow forecast, and that's a worry. A couple of other things that they're looking for at the moment is your unused credit lines. So you're going to go to the bank to borrow money, but in terms of you as an individual, especially if you're a sole trader, what lines of credit do you have that you could invest? Now, that's not to say they are asking you to invest, because it could be your credit lines are all in credit cards, which I advise completely against in using as borrowing for your business. but they will look at your total position of the business and also the individuals that are named on that loan as to what's your unused credit line. So make sure that you know what they are, and whilst you don't have to use them, be confident that when you're asked a question about the unused credit, or you're challenged about not using your levels of unused credit, you have a response for it. The final thing that's come up really, really strongly over the last 6 or 7 weeks is an understanding of what the liabilities currently are in terms of directors' loans. So a business will get off the ground in terms of the startup capital, because normally a director, you, the business owner, will invest a level of money. Now, the perception of that is that you will get that back either on the sale of the business or over a prolonged period of time. Any person investing, say, £50,000 into a business is not expecting to get £50,000 out within a week or a month or even a year. It's highly unlikely, but that will be carried as a liability on the balance sheet, because at some point that money's got to come back out. And what the bank will want to do is be cautious of how much liability is set in the business based around your director's loans. But more importantly, they're starting to look at the degree of loan versus your director investment. So, for instance, if you're investing £500 but you're asking for a £100,000 loan, there's a little bit of an imbalance there. Now, that's not to say they won't loan, but you might find a higher interest rate, or you might have to jump through some more hoops. So just be realistic in what you're asking for. Yes, ask for the loan that you know that's going to help invest in the business. Don't ask for more just as a surplus, because that's just paying cash for cash. But understand that if you've only invested a small amount and you're asking for a larger amount, banks are actually going to be a little bit nervous about that, because they will want to see that you've got skin in the game. You're actually investing your hard-earned money in your idea, and you're using the bank to just help push a little bit further. So hopefully that makes sense today. Again, if you're not looking to invest in your startup, if you have no need for investment, then this video is probably not for you. But for those of you that are startup or looking to get business loans to support your growth, it's important that you've got all of those numbers. Yeah, you've got your an understanding of what investment you've made, your lines of unused credit, your revenue, your current and projections, your profitability, and your cash flow. And having all of those in a nice application will give the bank greater confidence and give you more opportunity of getting the loan out of the financial institute that you want. Anyway, thanks for listening. We'll be back next week with another video, hopefully helping you on how to grow your business. I shall speak to you soon.